Hey, what's up everybody? This is Tim Warlow with the Countdown Realty team at Keller Williams in Bernie. And today I'm going to talk to you about lease purchase options and seller financing options, which are alternative ways of securing a home or a commercial property that might be a good fit for people who aren't quite ready to pull the trigger on a mortgage. So the two things we're going to talk about are the terms of a lease purchase option and the terms that you negotiate for seller financing. They are two different concepts, but sometimes people get confused, and as alternative financing ideas, they work really well in very particular situations. Rent to own has become very popular as a way for people to get in on a purchase price and secure a home while interest rates are good and they work on their credit so that they can get approved for a traditional mortgage. So let's talk about lease purchase options first. These are both commonly used for residential and commercial real estate, and I have worked primarily some deals that involved commercial real estate seem to be more common, but recently they've become more common in residential as well. So the terms of a lease purchase option work like this. You negotiate a purchase price of the home, you negotiate upfront the terms of that purchase and put down earnest money, but instead of closing on it right away, you agree to pay a certain amount of rent per month to the owner of the property, and a percentage of that rent goes towards your purchase price. That amount, that percentage is negotiable. Some people do 50%, 70%, 80%. Some people might have 0% of that go towards your purchase, but your purchase price will stay secured and will stay where it is. The terms of these are usually short. It's usually a 12-month lease purchase option, and there's a date that's given where you have to decide yes or no, I'm going to move forward. Yes, I'm ready for a mortgage. I'm going to put down a down payment. I'm going to move forward with a traditional mortgage, and that lease is going to expire and we're going to close on the property, and now it's going to be ours. So a common scenario that you might see is that somebody who has, let's say they need a 620 credit score in order to qualify. This would be traditionally like a more conventional finance route. Maybe they have like below a 580 credit score, but they have good income. The lender says, look, if you give me 6 months, we can make this work and we can get your credit score up 20, 40, 60 points. You're going to pay off some debt and we'll have you pre-approved in 6 to 12 months. What you would do is go to the owner of the property and say, hey, we're not ready yet, but the lender says we'll be ready to buy in 6 to 12 months. All we're working on is our credit. We've got a good job. We can pay rent. We can pay a mortgage if we needed to, but we just don't have the credit score that we need. Or alternatively, in commercial, the business just started up and the business doesn't have a track record. So similar idea, the business is opening, they need that money. Instead of a down payment, they're going to use it for operating expenses, and they just want to secure the property for a certain period of time and lease so that you don't have that huge upfront payment. You're going to go to the seller and you say, I need 12 months. And in within 11 months, I'm going to decide yes or no. I'm going to purchase this property from you for X amount. Let's say it's $500,000. For most of the time, that's a good way to secure the price, because 12 months from now, at this rate, could be 3, 6, 10% higher price. So that 500 could be worth 550 12 months from now, but you're going to pay 500. And each month, you're going to agree to pay a certain rent. On a property like that, the rent might be $2,500 or $3,000 a month. And if it's commercial, you'd also pay the taxes and utilities in what's called a triple net lease. In residential, your rent would typically cover the taxes. So let's say you go to them, you say, I'll buy this property from you 12 months from now for $500,000. I'll pay you $2,500 a month, and I want half of my lease payment to go towards the purchase price. Okay, so every month, you pay $2,500 and $1,250 of that will go towards lowering the amount you're going to pay. So month one, that number goes down to $498,750. The next month it goes down again, and goes $1,250 every single month. That is going to help you, because rent is no longer just going towards the landlord. It's helping you pay down a balance that you have. And then 11 months from now, let's say your credit score is good, or your business has become fully operational, and you have the credit and you have the business savvy to put down a down payment and close on that with a traditional commercial loan. That balance that you owe is going to be lower sometimes it's not. It depends on how you negotiate. And additionally, you're going to have, the terms of the contract are already spelled out. You have the purchase price, you have an option period, which is irrelevant typically because you've been there for 11 months. You have financing contingencies. You have all of that already done, basically a purchase contract signed and executed. And on month 11, you say, I'm ready to go. 30 days from now, you close on the property. This does work well for some people in those circumstances. Now, there are some caveats. Obviously, if you are leased to purchase that property and you don't qualify, you lose the earnest money that you put down. You could lose the deposit that you put down. Additionally, in that time frame, interest rates might go up. So instead of getting a 4% interest rate, you get 4.5 or 5%. Same is true in commercial. And typically, that just means that you got to be aware of those things and try to get ahead of them before it becomes an issue. So the next thing we're going to talk about is that's what a lease purchase option looks like. You negotiate up front to close at a later time, and you pay a lease amount. Now, a seller finance is different. Seller finance looks like this. You make an offer on the property for a certain amount. You give the seller the down payment towards the principal. You get a note for the property, and the deed and deed of trust have your name and the seller's name on them. So the deed actually transfers to you when you do owner finance. You own that property, but the seller maintains a note. So they maintain debt using the property as collateral. In a seller finance option, you're going to negotiate your interest rate with them, your monthly payment, whether that's going to include principal and interest, your balloon term, usually 3 to 5 years. That means you need to refinance the property in 3 to 5 years, and your amortization. If you have principal and interest, you're going to amortize that total note over 20, 25, 30 years, and that's going to change how much you pay per month. So you can have a situation like this, same property, say it's $500,000. You can't get approved for traditional finance for some of those reasons we mentioned, but you have a lump sum of money. You have decent credit because they are going to have to check your credit and your ability to repay. The Dodd-Frank Act did determine that the seller in an owner finance situation does need to determine that the buyer has the ability to repay that debt. And you do that through verifying that they can afford the mortgage and that they can afford the down payment. Those funds need to be verified, credit checked, everything like that. So you go to them, you make the offer, you say, I'm going to give you $500,000, I'll give you 20% down, and I want to carry that $400,000 note for 3 years, and after 3 years I'll refinance. That's called a 3-year balloon. And I want this amortized over a 30-year time frame. Now, if you do 30 years, your payment's going to be lower, but the amount of principal you're paying off is going to be lower as well. So after 3 years, you probably haven't even paid off, 2% of the property, maybe 3%. But the principal in the beginning is much lower. You're mostly paying interest. This is a good scenario for people who have a down payment, who make decent money, but maybe, again, don't have the credit to get traditional finance. Something could have happened in your life, or maybe you are a bank statement person. So you could have a trust, and trust funds don't count towards leverage. So a bank won't give you money based on the trust payments that you get. They may not give you any credit for different businesses that you have a lot of write-offs on, but you make good income. So in commercial, this is good. You can look at the cash flow of a business and say, this business has good cash flow, but it doesn't look like they would be creditworthy because they have all these write-offs. Maybe they have a big lease payment, and instead of using that lease payment towards the mortgage, the bank doesn't see it that way. They just see that as additional debt, and it throws off the ratios. So for whatever reason, the buyer can't get financed, or they just want to go an owner finance route because you can close faster. You don't need an appraisal. You don't need an inspection. You don't need a lot of things. In this case, it's beneficial for the buyer and seller for these reasons. So owner finance is beneficial to the buyer and the seller for these reasons. For one, it's a faster process. So the buyer can get qualified faster. There's not as much underwriting that has to take place, if any. And really, they just need to show that they have the ability to repay and put down a down payment. They can get qualified very quickly, and this doesn't go on their record. So this type of debt, this mortgage, wouldn't show up on anybody's personal record when you pulled a credit report. And that means that you could still go get traditional finance for other things like your home loan, and this loan wouldn't affect you. It's beneficial for a seller because they can typically continue to make money. They take an upfront profit and they secure the property as debt. That means that if the person defaults on the property, they can foreclose and take the property back minus legal fees and whatever is owed, and they can either sell it or they can hold on to it. They get that property back. That is a securitized asset secured by debt that is very safe for that person. And additionally, in those first years, in those 3 years that they have this balloon payment that they're waiting for, they're going to make a ton of interest. So if you had $500,000 worth of debt on a property, or say $400,000 worth of debt on the property, and the buyer was paying you a 6% interest rate, in those first 3 years, you would be collecting somewhere around $20,000 to $25,000 in interest only. So instead of selling the property for $500,000, your actual net is closer to $575,000 in those first 3 years. Now my numbers might be off, but I'm just giving you an illustration that $500,000, instead of just selling outright on the market to a qualified buyer, you'd actually make a lot more money if everything pans out. Additionally, you now have an asset. It helps with capital gains because you haven't actually gotten that money. It's just debt. And holding debt for the buyer and the seller is actually better than if you got all that cash up front and you needed to pay capital gains on it. The downsides are there's three basically. You're working with somebody, the buyer is now working with somebody who's not an actual bank. And sometimes there's personal feelings that come involved. It's not as professional. The owner of the property might be upset if you try to tear down the property because they feel like they still own it. Although the reality is you do own that property with all the rights that you are given as a buyer. So a buyer could buy a property, seller finance, and then literally tear the house down, and they would be within their legal right to do so. The seller might not like that. I mean, there's a lot of reasons that they might not like you making changes to a property that they still hold debt on. The other thing is you, as a buyer, you don't have full control. The contract will stipulate whether you can sublease the property out or sell in that 3-year time frame. So if you're looking to flip a property using owner finance, you need to be aware that the seller could stipulate that you cannot sell this property in those first 3 years. After the 3 years is up, you have to refinance. If 3 years from now you cannot refinance and the landlord or the seller will not renegotiate your debt, you could lose the property. So you have to be aware that you need to be on that timeline and try to refinance quickly. There could also be a prepayment penalty that's involved. There's a lot of negotiation that goes on with owner finance that wouldn't happen in a traditional finance contract that you need to be aware of. And additionally, you have to turn in all of your financial documents directly to the seller so that they can verify that you're approved. There's another way to do this that's called a contract for deed. So contract for deed or deed in lieu of foreclosure, which means instead of going through a traditional foreclosure process, if you default on the loan, you will literally just hand the deed back over to the owner, and they won't go through a foreclosure. There won't be a judgment. There won't be a lien placed on the property, and they're not going to take you to court. Essentially, you just have to hand over the deed. If you miss one payment, though, if you miss just one payment and you default, that seller can take the property back. So there's some things there that you're not going to encounter in a traditional mortgage. For the seller, we talked about some of the benefits. So they're going to make more money on the interest. They're going to secure the debt. They're going to have that asset. They're going to continue to have the write-off of the note. They are going to make some profit so that it will look like they're making more income. You can actually use that note that you have. You could sell that note to somebody else, to like a servicer. So that's another benefit. But ultimately, there's a lot of reasons that somebody might want to consider this route. We have two alternative finance options there. We've got lease purchase option, which is good for commercial property. I honestly would not necessarily recommend it for residential, but if you're in that situation and you need it, there's no reason not to if you negotiate it right. And then you have owner finance, which I love owner finance. I have clients and investors who only do owner finance where they buy the property, sell it, owner finance it out for more than what they paid for it. Land is a great way to do this because land can't really be destroyed in any way. So if you bought land and you paid $40,000 for it, you could owner finance it for $80,000 for 15 years. You're just going to securitize that debt on the land, and then you're just going to let them make payments every single month. So you're going to create cash flow for yourself. You also could take a down payment. If you paid $40,000 and you owner financed it for $50,000 or $60,000 and you took a 20% down payment, you would get back 12% or $12,000 right away. That would go towards your cash on cash return, and then that monthly payment would just a lot of it would be interest up front for the first 7 years. Most of your mortgage payment is just interest. So you could sell that, you could do whatever you want with it. Those are two options that I think people should know more about. I know my clients, even savvy investors, don't necessarily understand the ins and outs of it, but the lease purchase option and seller finance option are fantastic alternative vehicles for creating wealth, buying property, and creating cash flow as an investor. Stay tuned. I'm going to try to do some more of these videos in the future, and I hope you guys enjoyed.